staff. Okay, do we need to modify the agenda at all? If not, then do we have do we have a motion to approve the agenda as written?
So moved.
Second?
Dan will second.
Motion and a second. All those in favor of approving the minutes for February 11th, 2026 as written, please say aye. Aye.
Aye.
Aye.
Opposed? Abstentions? The agenda is approved. Next item on the agenda is approval of the minutes for January 8th, 2025. Do we have a motion?
So moved.
Second?
Second, Dan.
We have a motion and a second. Any discussion on the minutes for January 8th, 2025? Hearing none, all those in favor of approving the agenda for January 8th, the minutes for January 8th, 2025, actually 26, please say aye.
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 Opposed? Abstentions? Motion carries. We'll now open the floor for any public comment. We will now close the public comment portion of the meeting. Next item on the agenda is the 403B Plan Quarterly Review. Welcome, Empower.
Thank you, Mr. Chair, and Happy New Year, everyone. Hope you all had a wonderful holiday season. So wonderful to see all of you. The Empower team here today is myself, Chip Sandville, I see Chip, and Nick Marinelli, and Scott Tetrick, who's our communications strategist. So on behalf of all of us, good morning to all of you. Before I launch or share my presentation that you've seen in the past, I just wanted to, I did something this morning. I now have some chat features available to me within my Empower network. So I printed something out, and what I will do is send it to Chip, I will send it to Bill to distribute and for all of you so you can have it for your records, etc. So what I did is I did a 24 presentation and a 25 presentation, and I had chat kind of give me an executive summary, if you will, of some of the changes and metrics. So if it's okay with you, I'm just going to read a couple of these, and then I'll launch my presentation, if that's okay with all of you. Okay, because we're going to focus on the exclusives. So with respect to I'll do the exclusive, non-exclusive, and then a combined. So with respect to the exclusive 403B plan, again, from 24 to 25, we saw an increase of about $25 million or 15% in growth. So we went from 163 million to 187 million. And you don't have to write these down. You'll get these numbers later. Participants with a balance also increased by about 33 participants from 2,873 to 2,906. The average account balance per participant increased by about $7,800 from $56,000 to $66,000. And again, that's probably attributable to the market performance that I'm sure Sarah will cover shortly. Participation and contributions. Participation rate looks like went from 14% to 13%. There was a slight decline. The average contribution rate, 6.1%, up from 6%. And then there were about 12% of participants that were contributing over 10% in 24 and now 13%. So that's had some positive improvement. Contributions, 24 to 25, we had 11.5 million in contributions. Last year, in 24, in 25, 14.46. So we saw an increase of $3 million in contributions. And it says here, just a little tagline says here, while participation dipped slightly, savings behavioral strengthened, higher deferral rates, and a larger percentage of participants contributing more than 10% indicate improved participant engagement and discipline. Then there's some retirement readiness scores that also improved. With respect to the non-exclusive 403B, assets increased by about 7.3 million year over year from 38 to 45 million. Participants increased to 900 from 851, so we added almost 50 participants. The average account balance increased by almost $5,800 from 44,000 to 50,000. And let's see here, non-exclusive saw stronger relative assets growth than the exclusive plan, 19 versus 15, with both participant growth and improved average balances, lifetime income, reaching goal. And of course, we know of the single deposit investment account that had a decrease of about $2 million, which is what we see in that run rate in the SDI. And that's been pretty consistent year over year, and it decreased by 53 participants. On a consolidated view across the board, from 24 to 25, we saw assets grow by 30 million from 222.8 to 252, about a 13% growth, and participants with a balance increased by about 29. Key takeaways: strong overall asset growth of 13% across your plans, meaningful improvement in retirement readiness and in the exclusive plan, higher contribution activity and stronger savings behavior in 25, and the non-exclusive showing solid growth, but still lower retirement readiness, and the SDIA continues to run off. So that is just a very high level year over year. And if you wrote those numbers down, great. If you didn't, don't worry about it. I will send you this one-page executive summary based on this new tool that I have. And I'm going to do it all for the plans going forward, where we can do quarter over quarter, year over year. It's a lot easier than page turning and writing down the numbers and doing all the calculations yourself. It's nice to have chat do that. Okay, so I'm going to now cover just some high-level money metrics for the non-exclusive. Again, for the in and out. Let me share my presentation here. Give me 1 second, folks. Can you all see my screen?
Yes.
Yes.
Very good. So here's the 403B exclusive plan. And again, this plan at the end of December, 187.7 million, representing 2,900 accounts. We're going to take a look at, the asset allocations category, equity having the highest positions, so to speak, how participants are investing, the various tools that are available to them, from advice, free online advice, target dates, asset allocation, and those that do it themselves. And of course, the average account balance here that we see for the year. Participation rate, contribution rate, lifetime income score. I just will pause here real quick on lifetime income score, which is pretty good. Again, this represents people, 577 individuals that utilize the tool to look at their income replacement ratio. And as you see, the average is about 76% of your plan. But now we're going to look at money in and then distributions. And of course, Chip and Nick are here to share some insights in terms of participant activity and, of course, answer any of your questions. So for the full calendar year, as you can see, we had 14.4 million contributions come into the plan, 14.3 left the plan. So we had a positive cash flow of about $164,000 here. And there's the breakdown quarter over quarter. And I'll point your attention to the bottom line where it says change in value. Obviously, for the first quarter, again, that was market valuation, right? Down $1 million. But for the remaining 3 quarters, we had positive and strong gains, market gains. And anyone that's asset allocated and properly diversified would have benefited from that, to the tune of, we had gains of 12 million, 10 million, and then almost 4 million respectively quarter over quarter. In terms of the contributions, large cap is your largest holdings. In terms of contributions, then let's look at investment strategy and the corresponding dollars. My total retirement, which is the advice component, which is a fee for service that participants pay, 3.4% of your assets. 159 participants are utilizing that, representing 6.4 million. Some have looked at the free online tools, which is a static tool that provides free advice in terms of recommendations. Then we've got target dates, 432 participants representing 28 million. Goalmaker, which is your asset allocation model, 1,100 participants representing 43 million, etc. And then the do-it-yourself is the other largest holding, about 40% or 1,100 participants, as you can see, do their own asset allocation strategy, which represents $108 million of accounts. When we look at the utilization by active versus separated from service here on page 13, let me just move my cursor so I can see the page numbers. On page 13, again, for the active participants, the number of participants and what specific strategy they're utilizing from investment perspective is all here for you, as well as those who are separated from service. So there are still a lot of people, and we're seeing, we're seeing this across our book of business. We're seeing more and more people that do separate from service, stay in plan, continue to utilize the tools, and many of them use it for various reasons, whether it be legacy planning, future endeavors, etc. But the good news, we're seeing more and more across our book of business of more and more participants, once they separate for service, stay in plan. Now, part of that increase is also participants that separate from service, but implement a installment payout method, right? So you have people that leave their money there, but there's also people that leave the money in plan while they're taking out installments as well. So that's part of that overall mix. In terms of contributions of that 14.4 million that we talked about earlier, broken down between Roth and some employer contributions. So you could see 9.6 represented the before tax contribution type source, million in Roth. Again, Roth continues to be a very popular feature across the board. Some employer contributions, and the other, that 2.2 million, that represents rollovers into the plan. So when participants are talking to Chip and his team and they have other outside assets that they want to roll in, they're rolling that money into the plan. And you can see the month over month kind of contribution rate here, the run rate, if you will, of all contributions coming into the plan. It looks like, highest at 2 million, lowest at 600,000, depending on when people are in school or not. But generally speaking, just under $2 million, a million, let's call it a million two a month, it looks like, coming into the plan. Now, money leaving the plan, 14 million that left the plan over the course of the year and the rolling 12 months there. Again, separation from service, 11.7 million, the majority of that 14 million represents individuals that left, took their money, and those that left and are taking installments. That includes both of those features. There's a required minimum distribution, 73 transactions there. Again, now if you're 73, I believe the new rule is now 73, you have to start taking your required minimum distribution. And Empower and the on-site folks will talk to participants about that. We'll remind them of that. Then other distributions, whether they were in service, hardships, credits, and sadly there were 3 death cases representing 80,000. So you could see the run rate there, month over month, looks like just a little over a million and a half maybe, if you took an average out there. So it almost equals out there, but we did have some positive cash flow for this program. Loans in the plan pretty much stayed steady. 40, 42, 43 loans. It's great. People aren't overly using loans, but it's there if they need it. So representing a small percentage of your assets in the plan, but it's there. And again, month over month run rate here on 17, 1 or 2 loans a month. Boy, it would be nice if everybody did this, but the loan feature is there available for participants. Net transfers and then GoalMaker participation. Obviously, we've leveled out around the 1,100 participants in GoalMaker going back quite some time, with the corresponding assets representing 23% of the assets and almost a 40% participation rate. And then there's more demographics here versus participants and the strategies: conservative, moderate, aggressive, and their age group, followed by the assets in those various age group based on their status. Just more documentation there. And again, what we did is we look at all your assets that are in GoalMaker that are listed here versus non-GoalMaker assets. So of the total assets in the plan of 187,000, you'll see what comprised of GoalMaker, what's non-GoalMaker. We list that for you there. And then over here, we're listing all of the 20 largest school districts that are representing. Mr. Chair, you asked last time how many people were doing the Phil 57 as well as the 403B. It's hovered at around 106 participants. So that hasn't changed. It went from 107 to 106. So that number is there. But here's the individual school districts with assets, participant, average balances, and just some actives versus separated loan balances, etc., just for information purposes, followed by the options that they have, etc., so forth. Which as it relates to some of this data, there is a fund change that's going to be taking place in April for the non-exclusive plan, I believe, and it's a Lord Abbott fund change that's in play as we speak, to be implemented very shortly in April. So that's that. Now, when we go into the non-exclusive plan, which I won't go into on it, it's pretty much following a lot of the same. But that plan has 45.3 million, representing 900 participants. A lot of the demographics are very, very much in line with the other one. You'll see, 3.7 in, 2.2 out, positive cash flow of 1.4. And again, valuations, balances, again, large cap funds seem to be the predominant asset class there. And a lot of statistics are the same. Very similar in demographics information with respect to my total retirement, investment strategy utilization, goal maker, and of course, the do-it-yourselfers, actives versus separated contributions. Again, when we look at that specific plan, 2.6 came in before tax, Roth, some employer, and 800,000 in rollovers into this plan. So that was the 3.7 in, and you could see the run rate month over month contributions.
Let me just.
Was there a question?
Sorry, I'm just trying to mute my camera. Sorry.
Oh,
my
it's
phone.
okay.
Sorry.
It's okay. No worries. No, please. If there are questions, please interrupt me. I just want to make sure we keep this flowing. In terms of distributions for the non-exclusive, as you can see, the 2.3 went out, 1.8 separated from service RMD. Again, very, very similar demographics to the exclusive plan and the non-exclusive, pretty much corresponding. Again, goal maker pretty much flattened out at 300 participants, statistics, funds, and school district information here for the non-exclusive. Again, the 20 largest here. Whoop, excuse me. And again, a lot of data there. I'm trying to balance, not hitting you with too much data because it's there for your reference, but at the same point, providing you that executive summary of what I did. And of course, the single deposit account here at 19.7 million now at the end of the year, 600 participants. And we talked about that run rate, about $2.5 million leaving that plan over the course of the year. I went through a real lot here because I wanted to, hand it over to Chip in a little bit with withdrawals, etc. I do want to ask all of you, what the executive summary that I provided in the beginning, kind of a one pager that I apologize for reading it to you. I didn't get it done in time, but I'll be including that going forward. Was that helpful? Did you find that helpful? I'm going to stop sharing in a minute. I can see faces. Did you guys find that helpful? Even though I read it to you again, I'll hand it out to you ahead of time next time, just so you have an idea from a high level executive summary. Was that helpful?
Oh, absolutely.
Okay. Some people are different. Some like, yeah, include it, don't include it. I just wanted to get just a sense of that.
Yes.
So,
Dave,
yeah, Tim.
from my end, I think anytime you can help us contextualize, these quarterly summaries are great, because they provide ongoing data, but helping us understand the bigger picture trends, I think is always going to be useful.
Excellent. I'll make sure I run. I'm just playing around with chat right now. I did a year-over-year executive summary. I may do a couple of different things. Show me just these. Show me just that, so I can fine tune it to what information you want.
I think maybe we can work on it with Sarah as well offline and think about how we might want to utilize that tool going forward. But thanks for introducing it.
Yeah, and I'm thinking of, getting to an executive summary that the board feels comfortable with, and then have all of the data underneath it that I don't need to go through, right? I'd rather spend time talking about, one or two things and what specific you want to see. So, and now I have chat able to do that with historical data. I'm able to put a lot more together. But yes, we'll continue on that, Tim. And a lot of clients, the feedback I'm getting is, yeah, this is great, Gabe. Can you add this? Can you take that away and provide it in this context? So I want to build it. What the beauty of chat is you can build it specific to what the needs are, right? So I will continue to do that going forward. Great. Thank you for that. Any questions for me before I send it over to Chip and Nick? Well, again, I thank you for your time and attention, and I apologize if I went through fast, and always available for questions. Mr. Sandville, I know you're there somewhere.
I am here.
Okay, take it away, sir. I'm going to go to mute. Thank you, everyone, for your time.
I'll apologize to everybody in advance. I'm just getting back after having the flu, and I'm in the coughing phase. So I'll try to cough as little as possible, and for that reason, won't talk for too long. Nick is here with us today. I think most of you know he was hired here fairly recently to take over Gillis's spot, and he's done a fantastic job. He's fully integrated now. I just want to let everybody know that he's completely up and running. In fact, a few weeks ago, he was at Colchester School District, and what happened there, we've been seeing happen in a lot of places where he was there every day for a week and had 45 appointments with people across the table, which can be difficult in schools. And he's which might be a record. He's going to South Burlington next week, already has 40 people lined up for that week to talk to people. And why I think we're seeing so much of this, number one, people want to meet Nick, but also people are really liking the retirement readiness review process that we go through with them, where we're digging into what's your pension going to look like? What's your Social Security going to look like? Let's look at all of this information, look at your goals, where you are now, what you need to do to get where you want to be, when you want to be there. It's a process. It can actually be a lengthy appointment, and people are making time for it. And then they go back and talk about it, and more people sign up to come see us. So we're happy to be seeing a lot of uptick in activity face-to-face in schools, along with still a lot of situations where before school, after school, virtually works better for people. They can bring their spouse, things like that. So we're still, of course, offering that as well, but definitely seeing a big shift towards people wanting to meet us face-to-face. Recently, Brian did the same thing, had a lot of appointments up in over in Champlain Valley, and then just recently did a couple of financial wellness presentations at Franklin Northeast Supervisory Union, where we just spoke directly about financial wellness type questions for a couple of different presentations there. So seeing a lot of activity, like I said, retirees, retirement readiness reviews, very popular. That's really what's going on right now. We're going to keep knocking on those doors and getting into as many schools as we can. A lot of in-service opportunities for us, and making sure we're there for all of those. And again, moving towards more face-to-face. Feels good to be back in the schools again. Any questions on what's happening locally? Wonderful. I made it through without coughing. Gabe, I'll give it back over to you.
Just a couple of an updates what you're going to be seeing, and you may see some material shortly, but later this fall, Empower is doing a refresh, if you will, of the participant site, to make it not only sleeker, but based on a lot of feedback that we got on information on helping participants focus on where they want to focus on the most. We did a lot of studies with participants, and it'll have all of the same bells and whistles, tools and gadgets, etc., but it's going to have a more sleeker design, a more friendlier look, and easier navigations. That is scheduled to be deployed in waves. Our government plans are going to be seeing that in the third quarter of this year. So more to come on that. So when you log in, you're going to start to see a different kind of look and feel, but would love to get your feedback when it does happen. And if you want, in future calls, we can, when I do get some screen prints and other things, I can share with you on what that will look like. But we're getting some very, very good feedback. And it's just Empower's way. Look, we got to keep reinvesting into business, right? Refresh these things and make it easier, and et cetera, so forth, because everything is about technology these days, right? So more to come on that, but we're pretty excited about what we've seen. And obviously you'll see more advertisement about Empower, et cetera, so forth. So trying to make some more brand awareness of who we are. So that's all I had. Are there any questions from the team for everyone? Well, on behalf of all of us then, if I don't hear anything, Mr. Chairman, again, thank you, and to all of you board members and staff. You know, we continue to work with staff and of course very closely with Sarah at RVK and her team. Thank you for the opportunity to allow us to serve your participants, your retirees, and to share, what we see here in the industry. And it's a privilege to doing business with you. Thank you. So, Mr. Chairman, I'll send it back to you, sir.
Okay, thanks, Gabe. Sarah, we'll move to you.
All right. Well, good morning, everyone. I'm joined today by Ramnik. I believe he was at the meeting last time as well. He's our relationship day-to-day quarterback for Vermont across all planes, and he plays a significant role behind the scene, putting together all materials, working on ongoing manager monitoring and everything related to the planes. For you today, let me share my screen and materials, and do let me know if there are any audio issues. I've been having internet issues last week, so please let me know if you notice anything there. All right. So for today, our agenda is to cover the regular investment update, followed by the our quarterly governance update that we'll do with you all every quarter, which is taking a closer look at managers of our own watch, sharing any updates or any changes in our thoughts or recommendations or perspective from what we had shared with you all that prior quarter. And then something we will be doing once a year going forward, like we discussed before, is doing an annual investment policy statement review with you all, just to refresh our thoughts, on the policy, get your perspective, and kind of encourage everyone to maybe take a closer look as well, and let us know if you think any changes throughout the year in terms of regulatory changes or marketplace best practices would warrant us taking a closer look at the policy this year. So with that, I'll start with the first item in the agenda, which is a quick capital market review, and then a plan update on your managers and their performance. Obviously, Q4 feels like forever ago now, but so I'll spend some time talking about what happened in the new year. But before doing so, maybe it's just worth remembering how eventful 2025 was, and we should all pat ourselves on the back for making it through a volatile year. And despite all of the forecasts from managers that we may see a recession at some point during the year, happy to report that the economy is still standing. Inflation continues to drift lower. Labor market are still strong, and despite some drama earlier in the year, I think 2025 overall delivered very strong performance for equity markets, as you can see here on the bottom left-hand side. More so on the international side than within the US, but US market that was not too bad. Mega cap US companies continued to lead the way last year. And after 2 difficult years for bond markets, we also had strong performance from bond markets as well. The US Ag was up 7.3% over the year. So overall, 2025 was broadly positive across the board. In terms of where we stand now, we refresh this capital market review every few days. Capital market indicators are changing all the time. So this is the latest data points we have for January, and that's where the market stands. Overall, just a quick overview of capital markets. The Federal Reserve, that's a group that sets interest rates, as you all know, has already cut rates 3 times last year, in September, October, and again in December. So that took the lower end of the yield curve, the Fed fund rate, to the 3.5 to 3.75 range. That's a significant decline, and you can see that here in the line, the dark gray line versus the blue line. And with that, at their January meeting, the Fed determined that they were going to stay put for the year. They effectively said policy now is just right for the moment we're in. We don't want to be too restrictive or too stimulative. We think this is a neutral place to be. And markets still expect additional rate cuts this year, 2 or even 3 rate cuts. But for now, the Federal Reserve is really playing it meeting by meeting, and they want to be data dependent. With those cuts, you can see that the longer end of the curve kind of increased slightly during the period, but compared to year end, it's actually like of the prior year, the longer end is still fairly stable. It was a volatile year for treasuries in general, as you can see here, but overall, There hasn't been significant rate changes during the period. Markets are currently watching to see now that the White House decided to nominate Kevin Warsh as the next Fed chair. Some market participants are viewing this as a more hawkish stance, maybe potentially less market friendly, but that's something we feel those concerns may be overdone at this point. The admin is very growth friendly, and we think the Federal Reserve is likely to stay accommodative in 2026 and will be paying a close attention to market reaction and the economy. Growth in 2025 has also been very strong, and you can see that in the dark gray line. After that big decline earlier in the year because of the folks front-running those import tariffs that were taking place, as expected, the economy rebounded in the second quarter and in the third quarter as well. Q3 GDP came at 4.4% real GDP annualized, and Q4 is tracking around 4.2% at this point, meaning over the entire year, we expect the total GDP number to be in the 3% range, very much in line with the 10-year average. And so nothing dramatic is expected for the year, despite all the uncertainty. Looking forward, we're seeing in terms of inflation, also similar outcomes of light gray line. You see, actually, inflation came down a little bit compared to earlier in the year. It stays, the latest numbers we have are for December, 2.7 for the headline inflation. Both are down actually from before and moving in the right direction towards that Fed's comfort zone. And then on the job side, unemployment, you see it's trickling up slightly over time. It held up at 4.4 in January. Under the surface, we are seeing positive sign in labor markets. Layoffs have not increased as was feared significantly. There were some headlines about big companies, tech companies laying off workers, but so far companies seem to be just watching markets and not pulling the trigger on any market cuts so far, but something obviously we're watching going forward. In bonds, as I said, 2025 was really a strong relative performance for bonds compared to prior years. What we saw in January was continuation of prior trends where high yield outperformed, lower quality bonds outperformed higher quality bonds. Emerging market bonds had a really strong performance. And as you can see, that blue diamond, this is where spreads are relative to history. So that additional yield you expect from fixed income investments compared to the past. And you can see it's at historical lows. So spreads are very tight. Markets valuations are above historical averages. And we're seeing the same story on the equity side as well. And we've highlighted that in the past. Within the US, within international markets, it's a different story, and it really varies by market and region. Emerging markets valuations continue to be great. We've seen a strong 25 from non-US equities, and so far this year, we're seeing a similar performance. Emerging markets are up nearly 9% in January. Developed ex-US also outperformed. In the US, it's a bit mixed. As you can see here, large cap underperformed small cap, and then value outperformed growth. So we're seeing a completely different story from 25. And there are a lot of people who think what happens in January tends to set the tone for the rest of the year. So are we going to see broadening in markets in 2026? It remains to be seen, but there is a lot of optimism around that, and it would be a welcome change for markets, given where large cap valuations are, as you can see here. and growth equities are really, their valuations are very stretched. So continues to be a good story for staying diversified across markets, and something that the zero price target date funds are definitely poised to take advantage of any broadening and the dispersion in outcomes within equity markets. So looking ahead briefly, we're watching a few things. We're watching valuations in tech and AI, concentration risk and capex spending in AI, as you may be hearing in the news. We're watching the Fed rate cuts throughout the year and their pace of easing, and markets are watching that closely. We're watching earnings, and we're watching the Supreme Court tariff litigation that's still ongoing. They haven't ruled yet on the tariff case, and this might have an impact on bond markets later in the year, depending on the outcomes. We're watching labor markets, as I said, given some concern around a softening in markets this year. And then obviously credit markets, as you may have heard, is something we're watching. There are early signs of stress in some pockets of private lending and lower quality bonds. But overall, everything seems to be going well, stay as she goes this year overall. So that concludes my market update. Any questions on that before we jump into the good plan update? All right. So with that, Gabe and his team usually did a great job with the plan metrics. So I'll keep it focused on your managers for the most part. Starting with the single deposit investment account. This account is now fully invested in the State of Vermont Stable Value Fund. We talked about this in prior quarters. This strategy is currently on watch, as you may recall, and we're going to provide a manager update here shortly about this one as part of our watch policy update. But as you can see here, in terms of performance, it's been pretty much in line with the benchmark here, which is a peer-based benchmark. And then we're showing a separate peer group performance here, and they continue to outperform the median in that specific peer group. So while we have organizational items that we're monitoring there, performance-wise has been doing well. Moving to the teachers' retirement plan, assets are at around 233 million, up from last quarter. As Gabe described, if you combine the exclusive and non-exclusive plan overall, cash flows have been somewhat neutral throughout the year. During Q4, maybe a slightly cash flow negative, which is something to be monitoring going forward, obviously, given how this is a plan where the majority of participants are in working age cohorts. So as populations age, you do typically expect to see those patterns of more outflows than inflows, but with a younger cohort that is saving at healthy rates, you do expect to see more inflows into the plan versus outflows. So something to keep an eye on. In terms of how folks are using the menu overall, you have the zero price target date funds. This is a great series that we really like. You have about 16% of participants and around 18% of assets are invested in the series. If you look at the overall do-it-for-me category, so you offer participants multiple options for those who are looking for an asset allocation fund or service. In addition to target date funds, obviously you have the managed accounts and goal maker. Together, they hold around 59% or so of participants in the plan, which is actually pretty in line with peers. But obviously, the average plan we typically see has more target date fund usage than this. But you offer more options here. And then for folks who are preferring to build their own portfolio using options that the plan has selected on their behalf, you offer 10 core options in the exclusive and nearly identical options in the non-exclusive plan. As we discussed last time, the exception there is the capital preservation option, being Lord Abbott in the non-exclusive and the guaranteed long-term fund in the exclusive plan. About 36% of participants are fully invested in the core menu on their own, and about 6% are mixing the core menu with target date funds. For those who want to really have the flexibility to use other options, you do offer the self-directed brokerage. Similar to before, hardly anyone is currently sitting in those in the brokerage account. Not something unusual. We see that across plans. In terms of changes compared to last quarter, nothing really notable here in terms of plan level allocations. We did make a couple of fund changes, as you may recall, in October, moving the Vanguard Institutional Index Fund and the Lord Abbett Short Duration Funds to a lower fee share class. Those changes are already reflected here. They took place in October. And then the change that you all approved at the January meeting, which is to move assets from the Lord Abbett Short Duration Fund to a Vanguard Money Market Fund, is currently in the works. Empower and staff are getting that done. And I believe expected implementation now is around the April timeframe, but Gabe, please keep me honest there if that's not the case.
Yeah, that's correct. No, that is the case. Yeah, we've got all the documentation. We're just working on the communication. But yes, early April will be that change on the Lord Abbott. Yes.
Thank you, Gabe.
All good to go. Yeah, thank you.
Thanks. Now, we like to put together this monitoring dashboard for you all, summarizing some key metrics to evaluate and help you all with your fiduciary duty. So we would note here any additional adverse changes that we've seen during the quarter. The only one to note here that we flagged for you is the State of Vermont Stable Value Fund, and we'll talk about that later. There was additional organizational and team changes that we want to discuss with you, but other than that, no changes to note. Managers, all the target date funds, as well as the most of your passive options are positively rated by RBK, and so are your active options for the most part. Fees are generally in line with peers, and with a handful of exceptions here, which we'll also talk about with your active funds, performance has generally been in line with peers. Active options in general, not just within your plan, have really struggled to outperform over the last couple of years, where performance has really been concentrated in a few mega cap names, tech stocks, and this hasn't been helped by the fact that your active managers also have those additional quality criteria for selecting managers. Lower quality firms, ones that don't have cash flows, that are highly valued, have unfortunately outperformed over the last couple years. Meme stocks is a term that has been going around. A lot of those tend to be firms that don't have really established moats or performance, and this has really impacted those two managers, and we'll talk about that in shortly as well. So in terms of cash flows, we do show that here. Obviously, aggregate cash flows for the quarter has been contributions have nearly offset distributions, as I mentioned. We've seen some contributions into your target date funds and passive options, but you see net transfers have been really and net cash flows have been positive mostly for target date funds and nearly neutral elsewhere. And so nothing else that I would like to talk through here with you all. We encourage you all to go through the historical manager performance and the additional information we include here. I want to pause to see if there are any questions on managers' performance specifically before we get into the watch list update and talk more about the three managers currently on watch. All right, so I think we're on time, so which is great. All right, so before we get into the watch list policy update, very briefly, I just wanted to let you all know that staff and RBK started this annual review cadence of the policy statement, as I mentioned earlier. The policy statement and watch list policy are not, as we talked about before, these are not set it and forget it type of documents. This is our handbook for plan oversight, and we actually reference it throughout the quarter for something like what do we do if we want to maybe recommend the manager being potentially replaced, or what is the specific criteria for putting a manager on watch. So this is a good manual for all of us to help us with our fiduciary duty here. So we encourage you all today to take a look at it and let us know if there's anything specific that stands out to you or that you'd like to discuss. As you know, one outcome from that policy was that we came back to you all in November with recommendations for adding specific managers to your watch list. And that policy creation process set clear guidelines for us on how to monitor those managers and when to place them on watch. This will be our first quarterly watch list update for you today, after the policy adoption in last September. And the point here is straightforward. As we discussed before, having a manager on watch doesn't automatically mean that this is one that is likely to get fired. It only means that we're seeing reasons for increased oversight and due diligence on that manager. We will be meeting with the manager more often. We will talk about your strategy's performance, and we've done so with all three of them. We will be providing you with additional updates, and as the policy states, within a 90-day period, we should be providing you all with a potential recommendation, and that could be either to make a change, but it could also be a recommendation to continue monitoring the manager more. We're seeing improvement, for example, but we don't feel we're yet at that place where we're comfortable removing them from watch list. So this is a process that we're kind of starting now. And before I jump into the specific managers, we are not recommending any specific changes to the managers at this time. But we do have a handful of updates to share, mostly within your Vermont Stable Value Fund. With that, maybe let's jump into the first manager here on watch, which is the Impacts Global Environmental Fund. This is a global all-cap equity fund, and that's your only active non-US manager on the menu. It manages to an all-country world benchmark, so it can invest across developed, emerging markets, mostly large cap, but can also invest in smaller cap companies as well. It's a fundamental bottom-up strategy, and it holds a small portfolio. And why is that relevant? Because with this strategy style, you can see higher tracking error relative to the benchmark, meaning performance can be much higher or lower than the benchmark from year to year, and they're not as benchmark aware as certain other strategies. They tend to focus on companies that are in climate transition solutions or renewables or natural resources are areas that they focus on, but they invest across sectors as well. You may recall this manager is on watch purely for performance reasons. Over the past few years, it has underperformed the benchmark. and which has weighed on the long-term results despite prior 2020 and 2021 performance being really strong. And the team, as we had mentioned before, has made some changes into their portfolio over the last 6 to 8 months, which we're happy with, in terms of repositioning their portfolio to be more defensive, less volatile, and which we think has contributed to somewhat better performance. But we still, as you can see here on the page, we're yet to see any meaningful improvements in performance. Like I said, it has been a rough year in general for peers, but they do rank also relatively poorly compared to peers still. So we hoping to see more updates there in terms of recommendation. The key question to monitor is whether those changes will make significant improvements going forward. If so, we will recommend removing them from watch, and that is our hope. Managers should be reviewed over a market cycle, so that's 5+ years, and so we do recognize that a lot of the underperformance happened within the a term of the last 3 years. So we think it makes sense to give them some grace, but and continue monitoring them. But we will share additional thoughts with you next quarter as well on potential recommendations there. Similar story with Calvert. So this is a U.S. large cap growth strategy, meaning they do have this growth bias, but they generally have a more core focus. So they are not heavily invested in growth options, which growth companies, which is why we are benchmarking them here to the S&P index. A similar strategy style being fundamental bottom up, not very benchmark aware. So they also have higher tracking error year over year. They've also had very poor performance over the last 3 years, which continue to. So between 23 and 25, they are also using the time and that period to add to their high conviction names and trimming where they feel valuations are stretched. So they're not trying to change their mandate or style, maybe to benefit from the current performance cycle and the outperformance of maybe growthier names and lower quality names. And this has hurt their performance. Going forward, we're monitoring whether we see improvement changes. And for that to happen, there needs to be changes in market leadership and broadening in market performance, which is something we saw in January. So if that were to continue, we hope to see Calvert doing well. But ultimately, the good news here with both Calvert and Impacts is that assets that are invested in those strategies are fairly low. So we have about 2% in Calvert and less than about 50 basis points in Impacts. The other piece of good news is that the sustainable landscape is very large, and there's many managers, many opportunities there for change, for making change if there's desire to do so. But as we said with Impacts, we think maybe watching to see how their performance improves at least for 1 or 2 more quarters, especially given changes in the market that we're seeing this year, is warranted. But we also would love to hear your thoughts as well. And if you have any comments or questions, or maybe think a different approach would make more sense here. Okay. All right, so we'll keep monitoring the 2 of them. And then the last manager that we wanted to highlight is State of Vermont Stable Value Fund. This is a Mission Square manager, and it's a multi-manager fund, meaning their underlying fixed income sleeves are sub-advised and managed by external managers. And it's a tiered structure. They have cash allocation, they have short duration, they have multiple sleeves within the fund. This manager was added on watch purely for the concerns around senior level turnover. You may recall we've discussed that Wayne Wicker, former CIO, departed in 24, was replaced by Karen Chang Wolf, and she was then also decided to leave the firm to be replaced by Doug Cote as CIO. And so that level of turnover was sufficient, we feel is sufficient to create instability within the fixed income team, and especially since Karen was the head of fixed income, and she was a well-tenured individual within the firm. So we just heard just a few weeks before this meeting that there was yet additional turnover within the firm. Their current CIO, Doug, also decided to depart. They weren't able to share with us specific reasons for his departure. It seems to have been sudden, and then a new CIO and head of fixed income has been hired to replace him. So given all that turnover, we feel there are more meaningful concerns around how much they are able to invest in their investment team. We're happy to see Oliver, Oliver Meng is a person, the lead PM on the strategy. He's been with the firm for a long time, and he has been co-leading the strategy with Karen Chang before she left. So that creates a lot of continuity. So that's a positive. Another one is the fact that performance has been reasonable. Cash flows have been in line with other stable value managers. There has been outflows, but they have not been out of line with what we're seeing in the marketplace. So given all those changes, we feel there is no reason to decide to make a swift change here. But we do feel that taking a closer look at that stable values marketplace could make sense, given that there are a lot of strong managers out there that do not have those issues with turnover and team instability. And the fact that performance is strong means that we don't need to make a quick decision or a big change. So Stefan RBK would like to maybe spend a couple of weeks digesting this new information, since it's fairly new, and discuss maybe potential next steps. One of them could be potentially recommending a review at some point within this year, and also we want to evaluate options for making a change, because as you may be aware, within the stable value space, the unwind process could take longer than with other strategies. Typically 6 to 12 months is the recommended time frame. Is what we see within the market to make sure you get the book value of your investments, which is in this specific case is not an issue at all, and something we do with manager. We change and replace stable value managers all the time. And in this particular case, given how good the performance is, we don't see this being a concern at all. But we wanna just look at we have had 2 meetings with the managers already, and we like to continue talking with them and evaluating those options before we come to you all at a future meeting with potential recommendations there. So Tim, anything you wanted to add there? I know we've talked about this at length.
No, I think for the watch list, I think the idea that animates our watch list policy and now how we're approaching this with the board is to try and move slowly and deliberately where we see concerns, kind of get out ahead of them, put it on the board's radar and think about it. There may be circumstances where, in the future there's cause to move swiftly, but I think the idea here is to just put a bit of a brighter light on the funds where we do see some cause to think about it a little bit more deeply, and then as Sarah said, move deliberately to any recommendation. So very much appreciate RVK's work in flagging these and doing the manager due diligence. And if the board has any questions on this, how the process is playing out, this is sort of a new format for how we oversee individual funds. We're happy to take any feedback.
Thank you, Tim.
Yeah, I think this
Any-
is really important. Yeah, I just think this is really a great step for us, both in policy and having you folks at RVK do this research for us. It's really important that when crisis hits in our investment lineup, we have to be. Well, it's not a type of thing that you can do overnight in terms of a change, and constant monitoring to make sure that we have the highest quality investment options for our members is essential. So I think this is really important, and as you said, a watch list is not evil. It just means that we're doing our due diligence, and I think that's really important. And I also want to apologize. I don't know if you can hear behind me. I've got elevator music blaring, and in the condominium I'm staying in, they're monitoring the emergency audio in all the units. So I apologize if you hear anything.
No, nothing at all. You sound perfect. Thank you,
Okay.
John.
Great, thanks.
Appreciate it. No, I appreciate the feedback and your comments. And we will, as I said, at this point, we are recommending keeping all three of them on watch. This may change, but that could possibly be our recommendation next quarter as well. But we will come to you with, additional perspective and thoughts, and we will continue to do, that heightened level of due diligence on all three of them while we monitor all the overall managers as well. So thank you all for your time. I think that's all RVK had for you today, and we appreciate the time and feedback as usual.
And just to be clear,
Thank you.
with the, I did list as separate items after the investment policy statement reviews. But I don't think that we are planning on sort of going line by line through it. Part of our part of the way we're doing that is spending the time to with staff and RVK, we've spent the time just stepping back. I mean, it really wasn't necessary to do too deep a dive since we just adopted these policies, and we're in the early stages of implementing them. It was more just to memorialize the fact that this is around the time of year we want to come back to this and take a minute to just step back. So this first one's less important. As we go forward this time, we'll just step back and maybe make a little bit more space for a discussion.
Oh, thank you, Tim. And like I said earlier, this could be a good time for you all to also take a look at the policy statement and watch list. And if you have any thoughts or feedback to us all, please do let us know.
Excellent, thank you.
Thanks, everyone. Great seeing you.
Questions, Sarah, or for Gabe and a power team? All right, well, thanks very much. Excellent presentation from both RVK and Power. Thank you for the information on the quarterly review.
Thank you all. Be well. Stay warm.
Thanks.
Thanks, folks.
Okay, next item on the agenda is the VSTRS administrative budget.
Thank you. And I'll take this one, Mr. Chair. And do folks see the presentation that I have on the screen?
Yes.
All right, great. So this year, every year we come to you with our budget, and as we've done it the past couple of years since I've come into this position, I felt like it could, the way we do it could be improved. And so we put together a new format and presentation this year, and I'll present it now. We're not looking for action today. We'll explain why during the presentation. But my hope is that what we're trying to do is convey to you in a bit more of a sort of executive level sort of overview, major drivers in our system costs and what it takes to administer our systems here. So with that. So I thought I'd start off with sort of the format from past years. What we would do around this time of year was we would submit the budget that we submitted to the governor for inclusion in the governor's recommended budget. We would submit that to you folks in December and January. We wouldn't split it out between pension and OPEB. That was never a format. I think it was because we weren't pre-funding our OPEB system. Now that we are, we're wanting to kind of drill down on that a little bit more and allocate costs to pension and OPEB. So we presented this to the administration and the legislature at around the same time. And then, as the budget process moves forward in the legislature, we would never really come back. Sometimes there may be changes made. There would be different sort of overall allocations to agencies generally or something specific to our budget. And we didn't revisit it. So what we were thinking, and then this format, when you look at it on the right, I always felt it was a little bit difficult to take in because it would present sort of on the same level items that were sort of over, $1.5 million and $2,000, to kind of present them at the same level. And I started thinking, well, that doesn't really help give a great picture of what we're doing. So this year, what we wanted to do is present it in a more user-friendly format. I'm not going to pretend like I made anything new. We pretty much stole the format that VPIC uses because we felt that was a really good format for presentation to a board. As I said before, it's intended to provide that executive level insight into our operations. And what we'd like to do is, this budget we may adjust it a little bit as we move through the budgetary process in the legislature. So we wanted to come back because at the end of the day, this board oversees our systems and our administrative expenses. So we want to, give you sort of a couple opportunities to look at the budget and understand it. And if you have any questions or concerns, let us know. So with that, I'm going to start with our combined system budget. And these are costs that are allocated to all three of our systems. This is what it takes total in the treasurer's office to administer the retirement systems. And so this year, the way I wanted to break it down is sort of our internal costs. That's what I'm calling administrative. Administrative costs are staff salaries, think like all of our salaries in the retirement division and elsewhere in the treasurer's office that goes to administering the retirement systems. Operational costs like space, fee for space, sort of equipment, things like that. There's a comms and mailing line. We wanted to break that out because that's, a big communications line item that goes to, the necessary costs to communicate with our members. And then there's the education and support. So that's, the cost for conferences, travel, those kind of things. So that's the overall administrative budget. the agency support, those are basically, the top four items these are fees basically given to us by the state that we pay to other agencies for support from those agencies. We do have access to the Attorney General's office. We have to pay for our audit. DHR provides us services, employment related, and ADS is the digital services agency that provides technical services. These are all allocations presented to us. I wanted to separately break out the MRB, the Medical Review Board. That was kind of buried in a line item before, but that is the costs of the doctors and the independent hearing officer that is used to that provides our disability benefit services. And then the third party services are, they're pretty easy to understand. It's, Siegel is the actuary. The audits, we hire census audit providers. They go out to a certain sample of our employing entities each year and sort of ensure that they're submitting the right contributions to VSTRS. We don't do everyone every year. I think we're on like a 10-year cycle where we get everybody in the teachers and the municipal system. Our health consultant, that's Steve May with Acrisure. Death match and people locator, that's, we have to do batch runs every year to make sure that, anyone who's passed away, we've caught and turned off a pension if we haven't gotten it reported to us otherwise. And we need to find people generally. So that's the service Thomson Reuters we use. Legal is our outside legal counsel. We have a law firm, Reinhardt, where particularly for things like specialized federal tax law issues that might come up, where we have that entity to give us advice as needed. Miscellaneous tech, that is sort of we have some vendors that we use for printing checks and for sort of consulting services on our sort of general cloud environment. It's relatively small item, but it's third party nonetheless. And then VPAS is it's Vermont Pension Administration System. That's LRS. That's a big one, who provides our pension administration system maintenance and more recently hosting services as well. So that's our third party services. And then VPIC pass through is what it is. It's we're allocated costs from VPIC for their investment services. So kind of just wanted to put that as a pass through because that, VPIC oversees that. And I think we accept that once it is approved by VPIC. So I kind of on this page did all the stuff I've done on these individual pages later, but this is just so that you can have the specific notes about each of the entities that I just went through. Should have done that page by page now that I'm realizing this, so apologies for that. And then this piece is the VSTRS specific budget. One thing I will note, just because of the way we submit budgets at the state, where we're asking for a new position, as we are this year, we ask for that sort of outside our base budget. So this budget here at this time does not include that additional position. That's why I just had that note. We're not sure if we're going to get it. It has to be approved by the legislature. So we just wanted to flag it on the side. But what you can see here is sort of where the changes are in our budget, what's driving things up and down. And I think what is pretty neat about this, it shows the percentage change year over year, but it also shows like how much it contributes on the far right column to the budget change year over year. So some things, you might see in miscellaneous tech, you might see, wow, 114% increase. Well, I mean, that's the difference of 8,000 to 16,000. So it's, it's not huge dollars. And my hope is that it helps sort of focus the attention on where the important cost drivers are. And what are those cost drivers? Really, it's, these three are what's driving the budget in this case. We have the mailing materials, and printing and binding. We've released our new benefits summary. We're trying to increase our game in member communication. So we're reflecting a slightly higher budget there. For the actuary, we have our experience studies that we're going to be completing this, hopefully this spring, and presenting in the summer, paying for in the next fiscal year. And then VPAS, the substantial change there, if you recall, we came mid-year with a request to include the hosting service that was not in our 26 budget. So what you're seeing there primarily is that additional cost of hosting. So that's sort of our budget, but then I stepped back and I thought, well, what are some other ways that we can look at the budget and think about it and understand it? These numbers don't tie exactly to the administrative budget that was just presented for prior years. I think these are from the financials. So I think there's a difference between cash and accrual method of accounting, but they're generally similar. And why I thought this was interesting is a couple of years ago, we started including our administrative costs rather than as a standalone item in the budget. We include them in the ADEC. So we have an assumed admin expense each year that's reflected in the ADEC, 45 basis points. That is it's based on projected payroll. Then in the valuations, we look at, well, what were the actual expenses as reported on our financials. And you can see, for example, for VSTRS, we had a big gain, then a loss. I'm actually suspicious that in the difference between 2023 and 24 is not that substantial, but it has to do with probably recognizing some costs in 23, not in 24. Recognizing additional costs in 24 that may have been incurred in 23. I think there's some timing there that is why that skews. And then we had a gain last year of about $500,000. So this isn't really germane to the budget per se, but I think it kind of tracks about how on this item we are comparing against our assumption, which for the past years is generally favorable. And then finally, we have a few things that are not included in our budget, and we just wanted to kind of share some projections. Some of these, I have to say, they're rough projections. So, for example, where we're projecting increases in Empower's fees, we're just extrapolating some based on past increases in member counts and assets. What the fee would be if we kept on that same trend. If there's a market crash or a bull run, that's going to obviously be different because we have our fees are based on assets. So some of that is, I'm trying to provide a informational rough guide, even if it's not going to be exactly correct. So for this board, we have the SDIA, the deferred comp. There's, I think that's the 457 plan. There are some teachers in that plan, so I think that's why the note for teacher. But more specifically, the 403Bs is showing roughly how much we pay in expenses for these plans. These are, and again, these are combined systems. So for RBK, this is the combined fee expectation and increase. Importantly, we have our teacher, the VHI and the HealthSpring, or teacher health insurance. Those increases are based on the stated rate increases for the coming year, extrapolated out for that second half of the fiscal year. And it's also just intended to show that we have a number of expenses that aren't reflected in our administrative budget for some discrete items. Barry?
Yeah, these are outside of the budget. Are these costs apportioned to the groups that use them, or are they coming out of the general fund or the general pension funds? I'm specifically looking at, like, say, the RBK fees or the Empower fees. Do those go to the users of the programs that they administer, or do they come out of our larger group?
No, they, so the Empower fees, for example, that's just an asset fee on plan balances. The way that works is, Empower pulls that out of accounts. They submit and they put it in our plan expense account. They submit the bill to me, and then I review it and I approve that they can take the money from our plan expense account. And for RVK, because we have some amount in the plan expense account, we are using that amount to apportion the 403B's costs of, their percent of that 94,000 in the current fiscal year, which is a small amount because we're doing it by assets basically. So the 457 plan, being the highest asset plan, is going to pay the lion's share of that $94,000 cost. But it's the plan expense account in the 403B plans that pay for the 403B share of RBK's work.
I see. So the plans generate an expense account that is administered by your office, and that's the money that you use to pay for these support services for those plans.
Yes.
Am I getting that right? Great.
You are.
Thank you, Tim.
That the way it generates that amount is, if you recall, in our last contract renewal with Empower, we were able to negotiate some fee concessions. So what we did was we held member fees steady. The fee concessions were not substantial, but they were enough to generate just enough money so that we could hire an investment fiduciary and do that additional work. That's where the plans kick off that. It's really small.
Yeah, great. Thank you. That's also, I just want to say, this overall presentation you're making is very helpful. I'm finding it better than ones in the past. So thank you.
Excellent. That's the goal.
Tim, I got a question on the non-expenses. So looking at that list, it seems that those expenses are absorbed by the people that are participating in these, in this list. Is that a correct read with?
Absolutely. For Delta Dental, let's look at that one.
Right.
That one is just, that's members only. The state doesn't pay for any of that. That's why I was like, it would be weird to put this in the admin budget, because then you'd have to be putting in all kinds of offsetting revenues and yada, yada. So this is, it makes sense to have it as a standalone. And so for that, for this year's $8.1 million, that's 100% premiums paid by teachers, state retirees, and municipal retirees. For the VHI and HealthSpring, those amounts are paid for by the teachers and the state, because it is a subsidized amount. So for each one of these, there's a sort of dedicated revenue stream that goes towards paying for it.
And this is really helpful because this also represents additional pressure or costs to members from their yearly pension. So this is very helpful. Thanks.
Yeah, no, it actually helped me, kind of put it all in one place. So figured I'd share it with everybody, and then next steps. What I'd like to do here is, I'm still trying to, with this new format, I kind of want to get feedback, see what feels right, and then I don't know if this is the right time to come to the board. Maybe we might come a little bit earlier in the year in the budget development in future years, but I want to move to having that a more engaged conversation at a high level. Like I don't think it's appropriate for the board to be kind of diving down into what's that mailing cost right there level, and I think you would probably all quit the board if I was asking you to do that. But I would like to have a conversation about it, because this is part of your fiduciary oversight of administering our fund to ensure that we're doing it in an appropriate way. So we're going to keep monitoring it as it goes to the legislature. They have to approve it as well. So if there's any material changes and whatnot, we'll bring it back to you, I think, as the session's kind of getting to an end in the spring, and ask for a vote on it. But again, right now, I just want to tee up the new format, sort of how we're thinking of presenting it and getting feedback.
Questions for Tim on the budget? Well, I've been on this board, Tim, for many years, and let me tell you, this is the first time that the administrative budget was clearly explained. I truly appreciate it.
Good, I'm glad. It actually took a lot of work, and I got to give credit to Bill. He dealt with me, trying to figure out how to read or utilize an Excel sheet for a long time. So I think he gets hazard pay for it.
Excellent. All right. Let me see. Next item on the agenda, any other business before the board?
Mr. Chair, if I could just do a brief legislative update.
Sure.
That couple things I just wanted to let folks know about. H567 is our Treasurer's Omnibus Bill. That's got our major initiatives, the funding task force, the transfer of OPEB responsibility. That sailed much, thanks in large part to David and others in our office, that sailed through House Government Operations. Really no edits, no concerns, and they voted it out last week. So that's good. Its next stop is House Ways and Means briefly. And then I think House Approps probably before it hits the House floor. So I think we're feeling that we're in a good position there. With respect to finances, our 8X are fully in the GovRec budget, and I think moving through the appropriations committees without issue at present. So good news there. And then finally, we've been concerned about our federal grant assessment receipts. We brought this to the board before, and so we moved in the Budget Adjustment Act. We asked that they include an additional $3 million contingency. Our initial estimate for this year was 13.375. Given the drop off of federal grants, we're now projecting about 6.5. So we have asked for that additional $3 million to bring our contingency to 6.8. We feel comfortable with that, that we'll be able to make the ADEC regardless of what happens on the federal grant receipts with that amount. That has been included in the House passed Budget Adjustment Act, and without any real concern, I think people understood the importance. And so it's now over to the Senate, and we're going to keep an eye on it and make sure it gets through there. David, is there anything else that you think we should flag to the board's attention, retirement systems related at this point from the legislature?
I don't think so. I think that was a good summary of where things are, Tim, and the less things that need to be flagged during the legislative process, generally the better. So I think we're in a good place. As of now, there's still a journey ahead of us, but we're in a good place for now.
Great. So any questions there from board members? All right, Mr. Chair, back to you.
Thank you. Any other business before the board? All right, I'll entertain a motion for adjournment.
So moved.
So moved. Oh, second, Dan.
We have a motion and a second. All those in favor of adjournment, please say aye. Aye.
Aye.
Opposed? We are adjourned. Have a wonderful day, folks. Thanks for a great meeting.
Great. Bye,
Thanks, everyone.
everyone.
Thanks all.